This just in. Philippine account. Urgent news. Undergrad need help in learning accounting. By Ram Trinidad. Manila, Philippines. Students in Darasal Santiago Isabel School are having problems in class. The problem they need help in is with their accounting subject because they don't know how to solve debit and credit problems. See more at page 6. So what should we do? Help them, of course. How? First, let's define debit and credit. What is debit and credit? Debit, an accounting entry that states the increase in assets and expense and decrease in capital, income, and liability. Credit, an accounting entry that states the increase in capital, income, and liability and decrease in assets and expense. Accounting conclusions. These are really important. It's related to the accounting equation. Decrease in asset is equal to a decrease in liability. Decrease in asset is equal to a decrease in capital. Decrease in one form of asset is equal to an increase in another form of asset. Increase in an asset is equal to an increase in liability. Increase in asset is equal to an increase in capital. Decrease in one form of liability is an increase in another form of liability. Let's use an example. On May 2015, Kiko Tianco started a food business called Kiko Tianco Inc. with the following transactions.
2015, May 15, invested 200,000 pesos into the business. May 16, bought food supplies from Cafeteria Inc. worth 50,000 pesos under credit. May 19, issued a promissory note to Cafeteria Inc. on his account. May 21, completed work for Rambutan and received cash. May 25, paid the note issued to Cafeteria. May 30, paid the electric bill.
Okay, so now let's talk about your first transaction, which is 200,000 into the business you invested. So let's talk about the conclusions. So since you're gaining money for the business, it's under capital. And since you're receiving cash, it's an asset. So its increase in asset is equal to an increase in capital. So now let's talk about your debited. Debited, under debit, it's an increase in assets. So you're gaining cash, so you put it under cash. And since you're talking about your credit, you're gaining a capital. It's an increase in capital. So you put Kiko Tianco capital since it's an increase in capital and it's the owner. So now let's talk about your second one. So for your second transaction, it's bought food supplies from Cafeteria Inc. worth 50,000 under credit. So since credit, it makes it a liability, it's an increase in liability. And since you're gaining food supplies, that's an increase in assets. So it's an increase in asset is equal to an increase in liability. So now let's talk about your debit and credit. So since you're gaining an asset, which is your food supplies, you put it under debit. And since you're gaining a liability, it's under credit, which is accounts payable, and the company, which is Cafeteria Inc. So now let's talk about your third transaction, which is issued a promissory note to Cafeteria Inc. on his account. So you're gaining a liability and also decreasing a liability since you're gaining a promissory note to another business and you're canceling out the accounts payable. So it's going to be a decrease in liability is equal to an increase in another form of liability. So your account debited, it's a decrease in liability. So you're going to put cancellation of accounts payable under the company, which is Cafeteria Inc. And credited, which is an increase in liability, which is notes payable Cafeteria Inc. Now let's talk about the fourth transaction, which is completed work for Rambutan and received cash. So you're receiving cash and you did service. So that's going to be an increase in asset is equal to an increase in capital since you're gaining cash and you did service income. So for your account debited, you're gaining cash. So it's an increase in asset, so you're going to put it under cash. And now for your account credited, it's service income since you did service for the business, which is under income. So it's Rambutan. That's what you're going to put for credit. So now let's talk about your fifth transaction, which is paid the note issued to Cafeteria. Since now you're canceling your liability and decreasing your asset since you're paying it under cash. So it's going to be a decrease in asset is equal to a decrease in liability. That's under your conclusions. So now let's talk about your debit. So since you're removing the liability, it's a decrease in liability, so it's under debit now. So it's going to be cancellation of notes payable for the company. For it, so it's Cafeteria Inc. For your account credited, since you're decreasing an asset that's under credit, you're putting cash. So now let's talk about your sixth transaction, which is paid the electric bill. Since you paid the electric bill, So under your conclusions, you're decreasing your assets and a decrease in capital, which is your expenses. So it's going to be, for account debited, since you're decreasing your capital, it's going to be utility expense. And for your credited, since you're decreasing your cash, it's a decrease in asset, so you put it under credit, you write cash.